This is Seewing Yee from the Yee Real Estate Network, and today's topic of my presentation is accelerating post-pandemic population migration to Florida and to Texas. All right, so this is a sort of a generic presentation. Is based on my opinions, based on my background and experience, of course, and this disclaimer is such that if you want to go over your unique situation, you have to consult your own advisors, your own financial advisors, whether they are legal advisors, tax advisors, or traditional financial advisors. All right, this is for illustration purposes, and this is my disclaimer. So this is a high level. So I'm focusing on the Texas and Florida market, and the specific is that just to reiterate, the top 2 or 3 fastest job population growth and population growth is clearly in the state of Texas and in Florida. So I'm going to discuss about the new constructions. All right, I mean, if you buy new construction single family homes and duplexes in a fast-growing path of growth markets such as in Austin Metro, the 75-mile radius in Austin, Texas, and the Metro, and also Central Florida, and for that matter, and also Southwest Florida, in which Cape Coral, Lehigh Acres, and La Belle, Florida, is located within that sector of Florida, and Central Florida, which covers many different cities within the 75-mile radius. And of course, in Austin, Texas, Metro, that covers the 75-mile radius up and down that the highway, the freeway, where you will have a lot of smaller cities within a 1-hour drive of the core of Austin, which is like Temple, Texas, Benton, and the outskirts of Austin. So what's happening with these markets is that builders are building new construction homes in a very fast growth. So what I've been seeing, and this is based on my knowledge, here's what's happening. So let's I'm gonna develop a 3 to 5 year plan for all of you, right? So again, these numbers are very generic. We have to adapt a little bit differently numerically based on the slight variations of the purchase prices with this new builds, new construction, okay, with the builders. So typically, I'm going to use an example of 165,000, but it could be less, or could be slightly more in these two markets. The new constructions, they could be as low as 139,000 to be as high as 225,000. Those are the parameters. Those are single-family homes rentals, but in duplex, we can go over a little bit later, anywhere from around how much, around 300 something thousand on a duplex new construction also. But I'll go over more details, but this is a potential 3 to 5 year plan for many of you, and this is based on 20 to 25% down payment. So typically you buy new construction for $165,000 property, single family home, you put 20% down payment. Your total out of pocket is 33 grand plus closing costs. So your total out of pocket around 38 grand to finance a purchase. So therefore your loan balance is 130,000. So when you because investors getting such a break with the buying directly with the builder through our network, we have some tremendous value proposition, meaning that we're buying at a below retail market value, typically 10 to 20% discount from the from the retail buyers. So having said that, this example 165K, for example, has been sold in the open market for a retail buyer for 195K. So you right off the bat, you have a walk-in equity around 30 grand on this particular example. So bear in mind, your purchase price is 165,000. The retail value in the recent purchases is 195,000. All right, so just keep that in mind for right now. And the 3 to 5 year projection is, again, this is just for illustration purposes. I'm going to use 7% annual appreciation rate on those new purchases. So therefore, even though you buy for 165K, the projection rate is using the real value of a recent purchase on this floor plan, which is 195K. All right, understand that? So at 7% appreciation at the end of the first year on this value, 195K, is the annual appreciation at the end of 12 months is 13,650, right? So 13,650 added on to 195K initial market value equals at the end of the first year 208,650. All right. Okay, so far so good. This is not rocket scientist. So if the second year of ownership, the property continue to achieve a 7% appreciation rate, which could happen because of the path of growth and the lack of homes. The demand for homes exceeds supply in all this market, as we mentioned. So the second year, the 7% appreciation will be multiplied by, by the new price, right? 208,650 multiplied by 7% equals 14,605 at the appreciation at the end of the second year. So 208,650 plus 14,605 equal, right here, equals 223,255, right, at the end of the second year, right? So follow along with me. Then let's talk about the third year. So the new benchmark will be the beginning of the second year. You have a starting point of 223,255. Again, multiplied by this projected 7% annual appreciation rate for the third year equals 15,627. So 223 plus 15,627 equal at the end of the third year 238,882. Follow me? So therefore, at the end of 36 months, based on the projection and this example, 238K 882, which is a fair market value, right? Minus your loan balance of 130,000 at the initial purchase 3 years back. So you have an equity of 108,882. Make sense? So far, pretty simple, right? Now what? What is your potential exit strategy at the end of the third year at 7% appreciation? I put down 5 year, also the 5-year plan in case you may not get 7% appreciation for the first 3 years. You may get maybe 7% first year, maybe 4% second year, whatever. But I give it a 3 to 5 year plan. Okay, I'm gonna try to make it as realistic as possible. All right. So at the end of the day, anywhere from 3 to 5 year price point, this number should reasonably apply. So you have an equity of 108,882. Right. Now what? So there are two strategies I have for you. So one strategy would be, bear in mind your total out of pocket at 20% down, maybe even 25% down, is around 37K to 40K cash total out of pocket, including closing costs. Keep that in mind. Your initial of 37 to 40K total cash down payment. I'm going to show you how the power of leverage can create wealth in a mere 3 to 5 year, and not even talking about long term. Although the ideal world for real estate investors are to buy and hold for a long time, for a lifetime, and even beyond as a legacy transfer, right? So, but this is again just one of my example of an exit strategy within 3 to 5 years for those of you that may want to consider that. So the first exit strategy at the end of 3 to 5 years, given this equity you have, 108K, is refinance. So let's go to refinance scenario. The market value at the end of the third year, 238K, multiplied by 70% loan to value. Okay, I'm putting the hat of a loan agent. So 70% loan to value multiplied by market value, 238. So let's determine how much can you refinance and keep this property, keep it going. So 70% multiplied by 238 equal 167, all right? 167 minus 130K loan balance. 47K is the potential equity cash out you'll have available. So at the end of the third year or the fifth year or the fourth year, whatever, if you're going to refinance the property, you can potentially have around $47,000 of free additional cash. With that money, I'm just giving you another example. You could put the down payment on a finance purchase, 20 to 25% down payment. You can buy 2 or 3 properties in Buffalo, Niagara Falls, for example, right? So we talk about leveraging, making your return very, very high using this kind of exit strategies. Or if you want to sell your property, which I do not recommend unless you really, really have to, at the end of 3 to 5 years, you may want to do a 1031 tax-free exchange, right? So the example is, okay, let's say you can do that. 238K selling price on a 1031 tax-free exchange minus the loan balance 130K. You still have the same $108,000 profit, right? No capital gains as long as you identify, properties within 45 days of the selling of the original selling price. Then, as long as you close escrow on the replacement property within 180 days and all I'm not going to go over the tax situation in detail due to lack of time, but the 108 profit, when you do a 1031 exchange, no taxes, right? Then equals minus some costs, closing costs, and few other fees. So your net cash available, which is 100 grand. So this 100 grand on a 1031, you could buy 5 or 7 properties in Buffalo and Niagara Falls, or 4 properties in Alabama, right? At 100 grand each, right? Or 2 or 3 properties in Florida at 200 grand, whatever, based on financing. So you can leverage this 100 grand on a 1031, not pay the taxes on the 1031 exchange. You're able to buy 5 or 7 properties in Buffalo, Niagara Falls, 4 properties in Alabama, right? Financing, that is, all financing, and 2 or 3 properties in Florida or Texas, right? At 25% down, so forth and so on. So see how it goes? Now, how about the apples, right? This is a very good, potentially doable exit strategy within a mere 3 to 5 years. All right, so let's continue with the presentation. And the topic of this, presentation, how how you can accelerate after the post-pandemic, migration of population. So giving okay, let me see how to explain this. Now, although this is a tale of 2 cities, we're comparing New York State, mainly New York City metro, okay, not Buffalo, okay, versus the state of Florida. So it's just sort of a pandemic apple to apple comparison. But we can also use the same thing in California versus Texas. So what I've been seeing is that based on this, the congestion, the overpopulation, and high cost of living mainly in California to the western region of the U.S. and then New York State in the eastern portion of the U.S. I'm going to predict that because of the new normal, many high-tech companies and many other companies are allowing workers to work remotely, right? So that could have a population migration effect in the western half of the U.S. and also the eastern half. So I suspect because of the freedom to work at home and to work remotely for many white collar employees moving forward post pandemic, that many of the employees will choose not to live in California, in the Bay Area anymore because of high cost of living, etc. Right? And then they're gonna move to some other affordable areas, But mainly, again, I don't want to spend too much time on this. So the western region of the U.S., made from California, when they exit, they're gonna go to Texas. All right, let's use those examples. And on the eastern portion of the seaboard, mainly New York State, happened to be the second most populous state. At least 2 years ago, now Florida have exceeded New York as the second most populous state in the union. So the because of New York and with the New York City specifically being such a pandemic city, right? Of all the infections going on and the cold weather and the high state income tax and the congestion and the high cost of living and the freezing weather for most of the year. Not only a lot of baby boomers and retirees are moving to Florida, but also millennials are moving to mostly to Florida. I'm not saying all of those people because of the obvious reasons. Florida, just like California, but Florida is very affordable and has been the fastest growing state in the union for the past 2 years and will continue to do so. So again, the high level recap in terms of pandemic movement of migration of people based on my estimation, you heard it here first from me, from the horse's mouth, me. But later in the next few years, you will see some economic data, economic trends that will validate my personal opinion. I believe that, right? I could be wrong, but I don't have a crystal ball, but I'm just making some predictions and trends, and it will, for the most part, will be validated, sooner than you think. So just again, you heard it from me here. So again, the people from the western part of the U.S., many of them will go to different areas, of course, other than the Bay Area, right? For those that want to leave, but most of them will go to Texas for obvious reasons. Texas with the high tech, especially in Austin, will have a tremendous amount of growth in that market. And of course, those live in the eastern part of the U.S., New York State, New Jersey, Massachusetts, Chicago, those cold weather areas, people, they will migrate. They will accelerate the migration into warm weather areas in the southeast, right? Southeast. But Florida, which is part of the southeast, I have to believe is the main recipient of all the acceleration of migration into mainly Central Florida and Southwest Florida. Okay, right. And this is just an example right here. It shows that why Florida is much more desirable to live in New York. You look at the population difference, you look at the state income tax difference, which is dramatic, the state budget balance versus and the COVID-19 infections. Florida is very, very minimal compared to New York City. That is okay, and the depth. All right. So with that in mind, let's continue with the next presentation, with the final presentation. So I can only talk about Florida based on this particular slide deck. And just bear with me, okay? Just have an open mind. I'm about to conclude within 10 minutes. Okay, so currently, all right, here we go. This is a slideshow for Central Florida. I could make the argument, it also applies to Southwest Florida as well. So, of course, Jean Gill, I'm going to mention, going to have a video. She can talk about all the highlights of this Central Florida presentation, but I'm going to go over my specific areas. I'm gonna go over the 6 floor plan, the 6 different products that she's offering, and I will do it very quick. I'm gonna go over the cash flow analysis portion of it. So all right. So I'm not gonna talk about all the related areas which Jean Gilliam's video can talk about. All right, the first property in the first floor plan I'm gonna discuss. Again, I have to do it real quick, okay? So bear with me. This could be a longer presentation than usual. But let's go to the cash flow analysis on Palm Bay, right? Palm Bay. By the way, all these 6 floor plan, there are some properties that are already to be sold. Then there are a certain percentage of the property are still under pre-construction status, meaning, it'll be built within 3 to 5 months for the rest of this year. So, so the inventory, it come and go. So you have to, talk to me directly or talk to Jean Gillum. Or in the case of Texas, you can talk to Ken Renner directly, so we can determine what are the available homes available to sell, what homes are completed, or homes are still about to be completed, so you can make your decision accordingly. All right. So Palm Bay, 4-bedroom, all these new constructions, right? Everything we're talking about. 4-bedroom, 2-bath, 1,700 square foot, and the our price going through my network, so we get a discount, right? Which is amazing. A retail buyer wouldn't have to pay 239K on this new construction, but your price is 220. So walk-in equity, right? That's the whole idea behind it. So let's use the benchmark 220K on this purchase price, and the monthly projected rents is anywhere from 1650 to 1800. Very, very realistic. By the way, at the end of the day, what I hear from Jim Gillum is no surprise. Even currently, we're under very tremendous pandemic scare, and who knows how long this will continue. I know. I mean, we are in a recession and all that, and unemployment rate has been very high, but there's a light at the end of the tunnel, that we are getting some slow reopening of the economy at pretty much all parts of the U.S. It's a stick by stick situation, so I feel very, very optimistic about the future. The recovery, I feel, would be very, very fairly quick. But then again, no one knows for sure, right? But as an investor, if you have a job stability, and you have the financial resources, and you have the motivation to do real estate, residential investing, the way we talk about it is a tremendous asset class, which will be least affected by this pandemic situation. Okay, so regardless what you hear, I know the media always paint a very, very negative picture. They always inject negative information on a daily basis. It can just paralyze a lot of people. But you have to separate the fact from fiction, and make a decision accordingly. So all I can say is in Austin market, and in the Florida market, in all the market that we're presenting, just so you know, we have a very little effect, or just very, very few. The occupancy rate in all our markets that we're presenting, what they are, is around 95%, and very, very few people defaulted on their rent or on a mortgage. And also all the properties that we have sold recently have been rented real quick, within few days, within few weeks, way less than 30 days. So there are we see like 20 to 40 rental applications per property that we close. So there's an abundance of people who want to rent, because, like I said, population and job growth still continuing right now in the neighborhood and the market in the community that we're promoting these new builds in Texas and in Florida. So, if you don't believe me, or whatever, that's fine. That's your prerogative. But do your research. You can contact my property manager. They will validate what I'm saying. At the end of the day, the rental market is amazing, right? I mean, there's so much, crisis going on out there, and yet the residential investment real estate property that we've been promoting in the areas that we're promoting is just going by normally. It just is truly, truly amazing. So yes, Anyway, so let's go with the cash flow analysis. I don't want to go over my exceeded time. So this 220K price in Palm Bay, it rent for 1650 to 1800, depending on what time of the year, what situation. At the end of the day, you put 25% down payment, right? You have a net monthly cash flow of 361 on the low end, and on the high end, net monthly cash flow is 511. So we're talking very, very good cash flow, very good cap rate, and all that stuff. So tremendous amount of return for you. So all right, let's go on. That's your first floor plan in Palm Bay, still selling very quick. Get rented very, very, very easily, which is surprising to some of you, but not to me. Okay, second floor plan. Let's go over second floor plan, which is located in Kissimmee, right below Orlando. Kissimmee, where Disney World is located. So this floor plan, this community, also very, very desirable. Otherwise, Jean Gillum would not promote them through the builder that she used. So this floor plan here in Kissimmee, single family home. Again, the retail market price is 230K, but to investors that buying through my network, you get a discount once again at 225K. 225K, 4-bedroom, 2-bath, 1,600 square foot, 2-car garage. is amazing. Warranty, 10-year warranty, all the kinds of warranties. Anyway, the gross projected rent is 1650 to 1750. So monthly net cash flow based on 25% down is 394 to 494 monthly net cash flow. Once again, very good return. The numbers meet my expectation. The cap rate is around 7%. Cash on cash return approximately 15%. All the numbers looks really good. Gets rented very, very quickly. Okay, the second floor plan, KISSIMMEE. Third floor plan is in 2 duplex floor plan in Poinciana, which is again the south of a part of Orlando, which is 1 hour below, like 30 miles away. Very fast growing. So the first duplex floor plan is with 2 doors, right? 2 families renting, right? 6 bedroom, 4 bath. That tells me it's a 3-2, right? 3 bedroom, 2 bath per side, which is amazing. 2784 square foot. So each door, each side is around almost 1400 square foot, but there's no garage. That's fine. So the market price is 380, right? On this duplex. So one unit is 190, 190K per unit. So let's break it down so you guys can understand me better when I break it down. 190K per side. Per side rents for, see right here, around 1550. Am I right? Yeah, 1550 gross rent per side. 1550 from a 190K purchase price per door, which is meet my expectation with good cash flow. Okay, so if both doors are rented, it's very easy to rent at 25% down payment. So you can have a monthly net cash flow of 944 on both doors. So each door will get you almost $450 a monthly net cash flow. So very, very good returns, very good cap rate, cash and cash return. So okay, so this one floor plan at 380K, very, very good. The second floor plan in Poinciana, the price is a little bit cheaper, I think, right? The first plan is 380. This floor plan duplex, another community, is 316, okay, for the entire purchase. And so the market, the retail market is sell for 350. Again, you got about $36,000 or $34,000, gap in discount savings if you buy through our network, right? All right, so 316. So therefore, wow, again, 3 bedroom, 2 bath on each unit. So each unit on this duplex, again, is almost 1400 square foot. There's no garage, that's fine. And then at 25% down payment, which is minimal for duplex or higher, you minus all the monthly obligations. Then at the rent at 2650 on both doors. So per door it rents for like 1325 minimum per door. The worst case scenario, if it rents for maximum 3100 both doors. So each unit would be like 1550. So 1550 gross monthly rent from a on per side would be 155K, right? 160K, almost 160K per door on this duplex at max rent at 1550. We're talking about very, very high monthly net cash flow. Okay, trust me on it, right? All right, so again, on a low rent range on both sides rented is 770 net monthly cash flow. On the highest rent projection on both doors is monthly net cash flow is 1220. I mean, we talk about real good cash flow on this duplex situation. Again, okay, follow me. So it exceeded my minimal benchmark for capitalization, really cash and cash return. You get my drift, right? So so that's how many floor plan. I think I went over 3 floor plan, right? And then the villages, right? The villages located in the Central Florida in Ocala area, around like maybe like 30 miles northwest of downtown Orlando. So for those of you know what villages is, like a tremendous retirement community for age 55 people and over, like 50,000 people living the city of villages, mainly people 55 age and over. Of course, we are renting these properties for anybody, not just age 55 people. And a lot of people are moving to this area. Wait until you will hear some of these cash flow numbers, which Jean Gillum will discuss as well on her video separately from my video presentation here, right? So much to my surprise, I thought, there are most single family home new construction in Central Florida usually are more than 180K. That's what I thought until recently. Now, I don't know how Jean Gillum does it. I know how. Well, she knows what she's doing. She's been in the market for many, many years here in Central Florida. This single family home new construction located in the close to villages is 3-bedroom, 2-bath, a mere, a little bit small, 1,700 square foot, but still have a 1-car garage, right? So cookie cutter is amazing, very good price. The retail price for people out there, for owner occupied people they want to buy, they have to pay 155K. And for investor, we allocate for investment homes through our network, you only pay 139K. Think about it, 139K, such a great value on a new construction single family home like this. 3.2, right? 3.2, I mean, it's amazing. All right, and then wait until at 25% down payment, you can put 20% if you want, but look at the projected rent, and this is real, this is not fake. The minimal projected rent to buy this cookie cutter, very low cost, good value single family home in this area, $1,250. The higher rent range at $1,350. Some of you keep asking, like, what situation you'll get these two rent. We don't know. Maybe the rental season is summertime, spring, summer, which is right now. You most likely can get $1,350, and then in the winter time, when you try to rent, which is lower rental market, you'll most likely get a lower rental range at $1,250. All right, so that's the reason we put this in here. But it's almost 1% rent to value ratio, which is amazing. You put 25% down, even at this low rent range, $1,250, you will get a monthly net cash flow of $455, which is amazing. If you get lucky enough, to rent it during the high rental season during the summer, the rent could be $1,350 on a purchase price only 139K. So at 25% down payment on the financing, by the way, financing you're getting like around 4.3%, which is a historical interest rate. Another great reason to buy right now, in spite of the crisis that we're facing. So look at this. I mean, if you got $1,350 rent at 25% down payment, your monthly net cash flow is a whopping $555. That is mind-boggling. You're not going to get these kind of numbers other than in Texas and Florida, anywhere else in the country. If you can come to me, you can debate me all you want. Any other 48 states out there, you can find any new construction in a fast-growing location. You can get a rental property for new construction based on these price ranges, based on this gross rent, and based on this rate return. I mean, I welcome you to challenge me, but you're not going to win. All right, that's the bottom line. Okay, forget it. Don't waste my breath. Okay, another model plan. I'll be real quick. On the same area, another in close to the villages. This one, higher square footage, as you can see, a couple of hundred square footage higher. So therefore, the price is higher, 159K on this one. But the projected rent is $1,450 at the low end, $1,550 on the high end. At the end of the day, monthly cash flow is either $540 to $640. Oh my goodness, this is too good to be true. But you know what? It is true. Some of these numbers are very conservative, believe it or not. We want to under promise and over deliver, right? So if you want to validate the numbers I've been telling you, talk to our main property manager for all these properties, the realty doctors, okay? Which Jean Gillum's son, Tom Wicklow, is the owner, and by all means contact his company to validate all these properties they've been renting for a while now. These are true numbers. Okay, ooh, that's enough. All right, that's more than enough. Thank you so much for attending Now this is a long video, I understand, but you know, you play it once, you may not totally get it. Play it again and again. Replay the video so you can digest what I'm talking about. I know I'm speaking very fast. I have a slight accent. I get it. Some of you may not understand my presentation, even though I've been in the U.S. for more than 50 years. Just so you know, right? More than 50 years I've been in the U.S. All right. Anyway. Not that you care. All right, so that's the end of my presentation. Thank you so much, and listen to Gene Gilliam's 25-minute video presentation, so you can connect to our respective thoughts. At the end of the day, to recap, I mean, even under this unique crisis that we're facing, and we don't know, the future is very uncertain. But if, as an investor, if you're motivated, if you're in a good situation, if you can overcome fear, if you're very, very courageous, right now is still the best ever to buy properties as an investor. Okay, thank you so much. This is Seewing Yee. Thank you for listening. Have a nice day. Goodbye.